Cybersecurity is an industry I've been watching closely for years. It doesn't always dominate headlines the way artificial intelligence, quantum computing, or robotics do, but in my view, it has something even more powerful going for it: longevity. This is not a sector driven by hype cycles or short term excitement. Cybersecurity is built on necessity. As the world becomes more digital, the surface area for cyber attacks expands, and that creates demand that doesn't disappear in economic slowdowns. Growth rates may not always look spectacular year to year, but what truly matters is how long that growth can persist. When I look at cybersecurity, I see an industry with decades of expansion still ahead. In many ways, it reminds me of advertising. Advertising has existed for centuries and will likely exist for centuries more. Cybersecurity may not reach that level of permanence, but it will remain a critical and fast growing industry for many decades as data, cloud infrastructure, and digital identity become even more central to daily life. With that long term backdrop in mind, the real question becomes much more practical. Heading into 2026, which cybersecurity stock actually offers the best investment opportunity today? To answer that, I'm comparing six major players: Fortinet, CrowdStrike, Palo Alto Networks, SentinelOne, Rubrik, and Okta. This is not about hype or headlines, it's about fundamentals. I'm looking at revenue growth, returns on invested capital, operating cash flow, and, most importantly, valuation. Everything starts with intrinsic value because valuation defines margin of safety and long-term return potential. Only after that do analyst opinions matter. Let's start with growth. Across this group, growth has been strong, but SentinelOne clearly stands out. From 2021 through the most recent trailing 12-month period, SentinelOne delivered a 72% compound annual growth rate in revenue. That's exceptional by any standard. At the other end of the spectrum is Fortinet, which posted the slowest growth in the group. Even so, Fortinet still compounded revenue at 19.7% annually over the same period. That's an important reminder. Even the slowest grower in this comparison is growing rapidly. Demand across cybersecurity remains strong, and every company in this group has expanded meaningfully since 2021. Given the rising frequency, sophistication, and cost of cyber attacks, I expect this demand to continue over the next 5 years regardless of economic conditions. Growth alone, however, doesn't create value. That's where return on invested capital comes in, and this is where real separation appears. Most cybersecurity companies struggle with ROIC, largely due to heavy stock-based compensation. Paying employees with equity boosts operating cash flow, but weighs on profitability and capital efficiency. Fortinet is the clear exception. Since 2021, its return on invested capital increased from 28% to 32.4%, making it the most capital efficient business in this group by a wide margin. Others are improving but still lag. SentinelOne's progress is particularly notable. While its ROIC remains negative, it improved dramatically from negative 169% in 2021 to negative 23% in the most recent 12-month period. That kind of improvement signals a business moving toward scale and sustainability. Okta has also made steady progress, improving ROIC from negative 38% to negative 9%. Palo Alto Networks moved from negative 5.5% to positive 4.8%. Rubrik showed improvement earlier, but that reversed in the most recent period, with ROIC declining again. Before moving to valuation, industry dynamics matter. In 2023, Palo Alto Networks made an aggressive move to gain market share by allowing customers to switch immediately without paying until their existing contracts expired, even if those contracts had 9 months remaining. That raised concerns about a potential price war. What happened next was actually encouraging. Competitors did not retaliate aggressively. There was no race to the bottom. That response demonstrated competitive discipline across the industry, which is a very positive signal for long-term profitability. Operating cash flow further reinforces this. Because stock-based compensation is non-cash, many cybersecurity firms generate strong operating cash flow even when profits look weak. Palo Alto Networks, CrowdStrike, and Fortinet consistently lead the group in operating cash flow margins. Okta and Rubrik are also cash flow positive, with Okta clearly outperforming Rubrik and closing the gap with the leaders. Now we get to the most important part, valuation. Using a discounted cash flow model applied consistently across more than 100 companies, intrinsic values tell a very different story than market prices. Palo Alto Networks has an intrinsic value of 155, while the stock trades around $181. That places it above fair value and outside my margin of safety. Despite business strength, valuation introduces meaningful downside risk. CrowdStrike's intrinsic value comes out to 385 compared to a current price of 455. Again, the stock is overvalued relative to fundamentals, leaving little room for error. SentinelOne stands out sharply on the undervaluation side. Its intrinsic value is $38, while the stock trades at $14.70, near its 52-week low. That represents a substantial discount. Okta also appears undervalued, with an intrinsic value of $130 versus a market price of $84. Fortinet's intrinsic value is $93 compared to a market price of $78, placing it in undervalued territory as well. Rubrik's intrinsic value is $80.62, with the stock trading around $77, making it fairly valued. Forward price to operating cash flow multiples reinforce this picture. CrowdStrike and Rubrik are the most expensive at roughly 59 times. SentinelOne trades at 41 times, Palo Alto Networks at 29 times, Fortinet at 22 times, and Okta is the cheapest at approximately 17.5 times. Now let's have a look at analyst recommendation, which will give us a 12-month price target and another layer of security. Palo Alto Networks is covered by 55 analysts, 41 buy, 11 hold, and 3 sell, with price targets ranging from $131 to $325 and a median of $230. Despite optimism, valuation remains a concern. CrowdStrike is covered by 54 analysts, 34 buy, 18 hold, and 2 sell, with targets from $185 to $706 and a median of $567. Again, optimism is high, but valuation risk dominates. SentinelOne is followed by 38 analysts, 24 buy, 13 hold, and 1 sell, with targets ranging from $15 to $36 and a median of $20. Even at the median target, the stock offers a 36% return, with far more upside if it approaches intrinsic value. Okta is covered by 45 analysts, 30 buy, 13 hold, and 2 sell, with a median target of $115 and upside of 36% if reached. Fortinet is followed by 43 analysts, 10 buy, 30 hold, and 3 sell, with a median target of $86, implying a 10% return. The high number of hold ratings signals caution. Rubrik is covered by 23 analysts, 22 buy, and 1 hold, with a high target of $130 and median of $50, suggesting a possible 50% return, but with higher risk. So which cybersecurity stock stands out heading into 2026? There is no perfect answer. When it comes to cybersecurity, I've always believed that this industry is unique. Unlike the hype cycles you see in artificial intelligence, quantum computing, or robotics, cybersecurity is built on something far more enduring: necessity. Every business, every government agency, every critical system needs protection, and that demand isn't going away anytime soon. It's a sector where growth might not always be flashy, but it is consistent, and it has the potential to last for decades. That's why, as I look at 2026, I prefer not to bet on a single stock. The cybersecurity landscape is inherently vulnerable and volatile, so spreading investments across three carefully chosen companies makes far more sense to me. At the top of my list is SentinelOne. This company is a powerhouse when it comes to revenue growth. From 2021 through the most recent trailing 12 months, SentinelOne achieved an astonishing 72% compound annual growth rate, the highest among the major cybersecurity players I follow. But growth alone isn't enough. Valuation matters too. And here, SentinelOne really shines. Its intrinsic value is estimated at around $38, while the stock currently trades near $14.70. That's a huge discount, offering both a margin of safety and the potential for asymmetric upside. Even if the stock only reaches the median analyst price target of $20, it suggests roughly a 36% return over the next 12 months. But if the market begins to recognize its true fair value, the upside could be far higher. For all these reasons, SentinelOne should weight 40% in cybersecurity investment. It's my core growth and value pick, a stock that balances explosive momentum with deep fundamental potential. My second pick is Okta, another undervalued name that plays a crucial role in cybersecurity's evolving landscape. Okta specializes in identity and access management, a niche that is only becoming more essential as hybrid work and cloud adoption accelerate. The stock is currently trading at $84, well below its intrinsic value of $130, providing a large margin of safety and strong upside potential. If it reaches the median analyst price target of $115, that implies a 36% return over the next 12 months. And if it moves closer to intrinsic value, the upside could be even greater. I would put 40% weight to Okta of total cybersecurity investment as well. It's a balance of growth and value, a stock that benefits from long-term structural trends while still offering a deep discount relative to its fair price. To round out my portfolio, I include Fortinet, which brings stability and cash flow strength to the mix. Fortinet may not have the explosive growth of SentinelOne nor the deeply undervalued status of Okta, but it offers something just as valuable: consistency and financial discipline. Trading at $78 versus an intrinsic value of $93, it's modestly undervalued and it generates strong operating cash flow along with impressive returns on invested capital, something few cybersecurity companies can claim. Analyst sentiment is more cautious, with many recommending a hold, but this conservative positioning is actually an advantage. Fortinet adds a defensive layer to the portfolio, reducing overall volatility while providing quality, reliable returns. For these reasons, I assign Fortinet 20% weight of total cybersecurity investment, using it as an anchor to stabilize the portfolio against potential swings in the high-growth names. With these three companies combined, the portfolio is designed to capture the best of all worlds. SentinelOne delivers high-growth exposure with the potential for asymmetric upside. Okta provides value and long-term structural growth, and Fortinet adds a layer of stability, cash flow strength, and quality returns. Allocated at 40%, and 20% respectively, this mix balances potential returns with measured risk. The weighted average expected return over the next 12 months comes to roughly 29 to 32%, a combination of strong growth, value opportunities, and defensive quality. This strategy is about more than just chasing the hottest names or following the crowd. It's about understanding the sector, measuring intrinsic value, and pairing that with strong fundamentals. SentinelOne, with its massive revenue growth and undervaluation, provides a high reward growth anchor. Okta gives exposure to identity security, a critical and expanding area, while still trading at a significant discount to its intrinsic value. Fortinet ensures that the portfolio isn't overly exposed to volatility, providing strong cash flows and a steady hand in an otherwise dynamic market. By investing in these three carefully selected cybersecurity companies, I can participate in the sector's long-term growth while balancing risk. This mix captures the excitement of high growth opportunities, the security of undervalued potential, and the reliability of strong cash generating operations. It's a disciplined approach designed to take advantage of the sector's strengths while mitigating its inherent vulnerabilities. This is not a financial advice. I just tried to present to data and fact-driven information backed by valuation and analysts' recommendation. If you like this video, please consider subscribing and leave a comment or like. Happy investing!